I'm here with Bob Johnson, and we're here to discuss what happened on Wednesday. So the Fed announcement on Wednesday, was it what you expected?
You know, I think it took all of us a little bit by surprise. They had been kind of building us up to the fact that, yeah, they were going to do some tapering, and certainly parts of the economy seem to be doing relatively well, and it seemed like maybe now would be the great time before Bernanke's term ended to kind of get going on at least tapering of some of the bond purchases, but they completely punted and said we're not doing anything right now, and we don't know exactly, but we need more confirming data. So that was a little bit of a surprise. On the other hand, we had been seeing some of the economic data getting a little weaker. Housing in particular had been getting weaker, and I'm wondering if they saw that and said, you know what, let's just wait. Maybe rates got a little bit ahead of themselves here, and maybe it's slowing the all-important housing sector just a little bit too much. So I think they did decide to pause, and unfortunately they also brought in their economic forecast, which is consistent. We've always felt their numbers were way too high, and they always seem to be thinking the economy is just about ready to take off like a rocket ship, and frankly, we just get the same steady but slow growth. So I think that's really kind of what's behind some of their thinking, that the economy was not as strong as they thought. They want more confirming data, and it looked like maybe it hit housing a little bit. So let's not do this right now. But they left us kind of up in the air. I mean, they didn't really tell us. They seemed to take a couple of metrics they had given us off the table. They kind of said, well, it'll be over by the time we get to 7% unemployment. And they kind of took that off the table. So that was a big surprise to us, that they really kind of gave us a little less data. It said, well, we'll know. It kind of said, trust us, we'll know it when we see it, and we'll start withdrawing some of the bond purchase. But they have been adamant that the very shortest of rates would be low for some continuing point in time. And they continue to bring in their inflation forecast in addition to the GDP forecast that we talked about. So it's certainly not a robust economy, which was the bad part of the news in the story. That yes, we're going to have free money for a while longer, so to speak, but unfortunately the economy's not so good, and that's probably why we're seeing this.
So does this change your economic forecast for the year for the U.S.?
It does not. I think it may have the effect of accelerating housing just a little bit. Mortgage rates are back down already today here on Friday. So we're thinking that it may help stimulate things, and people that kind of missed the last rate decrease, this may really kind of bring them in. And maybe that's what the Fed intended in this temporary ducking the issue. That and certainly the other thing that was on the Fed's mind as they did all of this is that the U.S. economy, or the U.S. Congress, is coming up on some important dates. Probably by the middle of October we will hit the debt ceiling, which has to be extended, and then we also start a new fiscal year here in the United States on October 1st. And here we are today at the end of September, and we haven't got a budget yet.
Okay.
And so they have to have a budget. And certainly some of the issues with Syria kind of delayed some of those discussions even further. But he deeply implied in his statements, Ben Bernanke that is, that they were somewhat fearful that fiscal policy had become so tight, and now we're going to have this threat of a government shutdown and a debt ceiling fiasco again, that he wanted to keep monetary policy and buyback programs in place to prevent any dislocations from those activities. Because we'd hate to have the double whammy of having no federal budget combined with, the very same day we're stopping buying bonds, would be a very bad combination. And so I think that was part of what was on his mind. So maybe we get past the fiscal issues in the U.S. Congress, maybe they'll lighten up a little bit sooner than everybody's thinking.
Okay, and what does this mean for the Canadian economy?
Well, I think that rates may come back in here just a little bit, and that may make the Canadian dollar just a little bit stronger, which is probably not a good thing for manufacturers, unfortunately. But certainly one of the things that the lower rates and the delay will probably mean is a strong auto industry, and the U.S. auto industry has been a big driver of overall economic activity in eastern Canada in any case. So I think that's certainly good news. And then also the fact that they're delaying the tapering gave the emerging markets a temporary boost. And obviously China is a big customer for agricultural products, for manufactured products, for the western part of Canada. So it certainly helps a little bit on that front. But again, we think that the Fed will have to eventually bring rates up, and the bond buying will at some point have to cease. And you can already see in some of the interest rate numbers, yeah, they're down a little bit, but we were at 1.6% on the 10-year Treasury, and maybe we got as high as 3. Well, now we're kind of at 2.7. We're not going back to the 1.6 regime ever again. Everybody understands this game's going to end. It's just kind of a question of when. So I don't think the impacts might be as huge as people think. And I don't think we're going to have this huge drawdown in interest rates. It will pull in a few people that missed the window, if you will, but I don't really think it's going to be a big deal. And I think overall the effect on the Canadian economy will probably be relatively muted. And I know there's a lot of other issues that are going on there, but certainly our auto industry continues to be very robust here, and any little change in interest rates won't make much of a difference to that industry, which is going gangbusters right now, and they're stepping up production. They don't have enough cars, and that will certainly be a very beneficial thing, and it certainly appears that both Europe and China are seeing at least a small pickup in their economies, and that will bode well for a lot of Canada.
Do you have any advice for investors who are looking at their portfolios and they're looking for things that will help with interest rate, the interest rate sensitivities really? So for things like a floating rate fund, do you believe in those? Do you recommend those?
Well, I think one always has to be cautious with any type of investment product and understand what you're getting. And on the surface, that seems to be a very interesting product because it readjusts every few months when interest rates go up. So if you're in an environment where you don't know if rates are going to go up or not, you've got this device that kind of automatically ratchets up. And lo and behold, it did hold up better than most other bond or fixed income products when we had the latest rate increase. So certainly from that standpoint, it seemed to work. It's kind of somewhere between a regular corporate bond and a high yield bond. It's not a secured credit. This is not a safe piece of paper necessarily. This is not investment grade. The reason you're getting these good yields is because they're on loans and banks to businesses that are less secure, and so that's why they command the relatively high rate and the feature where the rates kind of ratchet up over time. To give you an example, they're probably running in the 4.5% range or so. A high yield might run something more like in the 6 or 7% range, which is even then the high yield is even less secured. At least the bank loan funds have some type of usual collateral behind them. But they're certainly not to be dare compared to anything like even a General Electric or General Motors type of bond that's probably a lot more secure than on the credit profile. Okay,
so I guess just do your research whenever there's new product.
You've always got to be careful, and you've got to remember with that even as well as these things fared, they didn't do perfectly. And when the higher interest rate environment, it takes a little while for all these things to adjust, and so they held up far better than anything else. But is it nirvana? No. But do they have some room in client portfolios? Absolutely.
Okay. All right, great. Thanks so much, Bob.
Thank you.
To see more of Bob's commentary, go to the market section of Morningstar.ca.